Hello, everyone. Welcome to the final bar. My guest today is Landon Whaley from Whaley Capital Group, going to help us think about the currency commodity complex, how they relate to what we're seeing on the charts of equities. Equities rallying into the close today. So after yesterday's distribution, today we get a little more accumulation. It's really solidifying this choppy range-bound environment that we've seen. We're going to focus on stocks making relative gains, see where the opportunities might be. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to today's edition of The Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close to look at these markets together through the technical, behavioral, quantitative lenses and try to connect what we're seeing today with what we're seeing over the long term, understand how these trends are evolving. I was speaking earlier with Ralph Acampora. We were recording our interview that we'll show you next week as part of our Charting the Second Half special week of events on StockCharts TV, and it was great sort of reviewing the long-term charts. And then we talked about sort of this push and pull, markets like technology, the Qs, for example, with consistent relative gains, and you pair that with something like energy making new swing lows today. And it's interesting how you have this dispersion, this differentiation between what's working and what isn't. So the good news is, from a stock picking perspective, I think there are opportunities out there. We're going to focus on relative strength today a little bit and look at some of the stocks that are really able to hold their gains, and the stocks at the upper end of the scooter rankings for each of the 11 S&P sectors. Now, coming up on today's show, we have Landon Whaley joining us from Whaley Capital. We have some other fantastic guests through the course of this week. Tomorrow, Javed Mirza, who's the technical analyst at Canaccord Genuity in Toronto, is going to join us on the show. Next week, as I mentioned, the whole week is called Charting the Second Half. It's really focusing on a second half outlook. We have some great guests on the show every day to share their perspective on what they're seeing. Rick Bensinger from In the Know Trader is going to be with us on Monday. On Tuesday, Tony Dwyer from Canaccord is going to join us as well. He's a macro strategist. Then, as a reminder, on Saturday, July 18th, we will wrap up our week-long special event Charting the Second Half with a live market forecast panel. I'm going to be moderating a fantastic group of strategists thinking about the second half of the year and what may be in store for us. So that's on Saturday, July 18th, noon Eastern, 9 o'clock Pacific. Let's get to our market recap. So, yesterday we sort of had distribution going into the close. So things sort of were holding in, but got weaker and weaker and really finished in a position of weakness. Today we gapped, traded higher very quickly out of the open, went into the negative just before lunchtime. But since after that point, we sort of rallied with the S&P finishing up near the highs of the day around 3170. So again, while this is not a dramatic break from where we've been over the last week or so, certainly finishing in a position of strength, suggesting accumulation going into the close. Technology and the NASDAQ certainly leading the way higher, with the tech sector up 1.6%. The NASDAQ 100 up about 1.4%. Mid caps and small caps both up as well, but less than the overall market. So that idea of small cap underperformance still remaining in play here, even today with the market moving higher. VIX back down to around 28. Let's look at some other asset classes, then we'll get to some of the charts here. Yields a little bit higher today, with the TLT down 0.4%, around 164.50. On the commodity side, gold actually continuing higher, sort of traded lower through the course of the day, but all up pretty significantly, with gold closing just above 170. We talked about that long-term chart of gold in recent days, just continues to impress, continues to chip away on upside. And again, does it concern me that stocks and gold are rallying on the same day? Absolutely not. I think we love to oversimplify and think stocks are going up, gold should go down because it's a safe haven, et cetera, et cetera. Remember, there are a lot of moving parts in these markets. Focus on the charts and what is happening. Don't worry as much about what should happen or could happen. Focus on what is happening. That's the benefit, obviously, of charts. Let's look at a daily chart of the S&P 500. So again, we finished more toward the highs of the day. We're still within the range that we've been in the last couple days. Really, this entire week, we've been in that 3150 or so range. Now, we broke out of this pennant pattern, which is a rally, then this sort of symmetrical triangle on a shorter term time frame, lower highs and higher lows. That resolved to the upside about a week ago now. And since then, we've continued higher. So from a tactical perspective, I have to acknowledge that the short-term trend is positive. Higher highs, higher lows, it's in an uptrend. So regardless of what I think might happen, the trend is positive, and that's where we need to start the thinking. Having said that, RSI remaining below 60 overall, you still have a lot of the divergences that we've talked about with some of the big cap technology names. I think still are in place with big cap consumer communication services. I think that's all still there. I don't think that's changed yet. So overall, you have this dichotomy of market indications that we're in an uptrend, that things are fine. The XLK going up. We're going to look at some of the basically the top ranked stock in every sector, and you'll notice that all 11 of them are in primary uptrends. Like the charts look pretty decent. So there are stocks out there that are doing very, very well. What's interesting to me is from a breadth perspective, and we'll look at chart of the cumulative advanced decline lines here. What concerns me is the fact that the breadth is not confirming these sorts of breakouts, right? So you have the cumulative advanced decline lines for the S&P actually has broken to a new swing high. That's over the last couple of days. On that big move 2 days ago, this went higher. This is not updated yet for today. So this is 2 days ago. This is yesterday pulling back a little bit, and then today will most likely be up with the market going higher. So with the S&P 500 sort of confirming the short-term uptrend, but if you look at all the other indexes, they are not. So you have the situation where large caps in a position of strength, others not confirming that yet. And again, what concerns me is that's sort of characteristic of a market top. You'd start to see divergences between large and small. You'll start to see small and mid cap stocks start to rotate lower. The S&P will hold up because the mega cap trade, the safety trade, will continue to work. Especially big cap tech and others will continue to hold up fine, while other stocks are getting beaten down a little bit. Theoretically, you sort of have people selling off the more speculative positions into large cap tech, and that would be sort of the last trade before everything starts to roll over. To be clear, I haven't seen that yet, but I think that's the potential beginnings of the patterns we're seeing here with a non-confirmation with some of these advanced decline lines. As long as they remain above their swing lows, and I think that's what's so important now. We've now created this support level of testing this a couple times. It sure looked like a breakdown of support, which now has bounced up a little bit. If and when we get these advanced decline lines to again break to new swing lows, I think that validates this short-term weak thesis that I think we would still be waiting for. Has certainly not happened yet. Let's look elsewhere around the markets to see what sort of themes we can tease out. I think it was interesting to see below technology, number 2 was financials, right up 1.1%. The lack of participation with financial stocks has certainly been a cause for further analysis to see what that means. But financial stocks rallying okay today and outperforming the S&P as a whole. Next we had consumer discretionary, and then utilities. Utes were actually up a little further earlier in the afternoon. So utilities actually had been sort of an underperformer, kind of a forgotten sector, but chipping away at outperformance today. The biggest, or I guess the weakest of the 11 sectors today was materials. And it's interesting because gold stocks pretty good yesterday, and overall have held up pretty nicely, potentially emerging as in a position of strength, and especially with gold continuing to go to new highs. But we didn't see that today with materials, with the sector going lower, and consumer staples next to last. So that ratio of consumer discretionary versus consumer staples now favoring consumer discretionary today. And again, if you look at that on a cap weighted basis, which includes the overweight in Amazon, it's essentially gone up and to the right here recently. What else can we focus on in terms of groups that have done well? A couple technology sectors that are pretty significant: computer hardware, software groups. So these are like Apple, Microsoft are in these groups, both up over 2%. So that's certainly driving the S&P higher. Home constructions, these are the home builder stocks, actually rotating back higher. And it's interesting to see this group actually testing previous highs. At times, it's felt like this was starting to roll over, and this is a group that broke above its 200-day moving averages using the Dow Home Construction Index. teased around sort of that 200-day and support just above 850, but now rotating back and testing those swing highs. So, indexes like this, industries like this, able to break to new swing highs. The more of those that I see, the more I'd feel comfortable with the S&P continuing on to 3,400, retesting previous highs. But these are the levels that these groups would have to get above. So it's the home construction index getting above the May and June swing highs, which we're still not quite able to do. Also interesting to see 4 of the top 10 groups today were all within financials. You had asset managers up there, specialty finance, and others. And I forget stocks like S&P Global. I forget if that's the specialty finance group or not, but some names in there certainly ripping to the upside pretty well. Speaking of ripping to the upside, the Chinese ETFs certainly have emerged very, very nicely. So, 4 of the top 5 all related to China, if you bucket EM in there as well. The chart of EM, it's interesting. It's easy to not think about this because we're focused so much on the U.S. markets and how they're doing. But look at the chart of EM. This is EEMs. This is the broad emerging markets ETF, but certainly has weightings in places like China and elsewhere. Look at the relative strength and how it's improved over the last 5 to 6 weeks. You may be surprised. I haven't looked at this as much recently, but it's impressive how the relative strength has come on. And with the gap higher this week, now following through to the upside and breaking to new, confirming a break to new swing highs, and certainly opening the way on the EEM to get back to previous highs around 46. So it's interesting. We're seeing breakouts in different pockets in the market, but not that full scale, broad rise showing you that the average stock is participating. It still feels relatively localized. We need to take a quick commercial break. We'll be back with my guest, Landon Whaley. We'll see you in a minute. Folks, welcome back to the show, The Final Bar. I'm Dave Keller here at StockCharts.com. Thanks for joining us every weekday for the show. As a reminder, we'd love to answer your questions on one of our next mailbag segments. Shoot us an email, thefinalbar@StockCharts.com. We've heard from so many of you over the recent months, especially dealing with the market volatility, dealing with the uncertainty. We're here to help you navigate the markets and navigate charting and technical analysis. So let us know what you're running into, and love to answer one of your questions on the air. Want to bring on my guest, Landon Whaley. Landon's from the Whaley Capital Group in Virginia, and so good to have you on the show, Landon, for the first time. Thanks for joining us.
Dave, thank you for having me. I appreciate it.
So it's interesting, I feel like so many people have ignored currencies, broadly speaking, because you had this situation with the dollar being so strong and people felt like they didn't have to have any exposure to non-US markets. Now, all of a sudden, you have dollar weakness, and I'm finding more and more people are looking at the currency markets than they had previously. The first chart that you've sent is looking at an important cross in there, euro-yen. Tell us what you're seeing here. What does this mean for you?
Sure. So two things that I think will be important for people listening in terms of understanding my perspective and how I'm approaching not just markets, but this conversation. Number one is I'm global macro, and that's just industry jargon that means we trade all 4 major asset classes, stocks, bonds, currencies, and commodities on financial exchanges around the world. Okay, that's number one. Number two is we've got what we call our gravitational framework, and the core component of that is what we call a fundamental gravity. What we do is we characterize roughly 40 economies globally in one of 4 seasons, fundamental gravity seasons, okay, spring, summer, fall, and winter. And depending on what season the economy is in, that sort of dictates the risk and return of various assets that trade in that economy. Okay, so to put it simply, given a particular fundamental gravity season, certain assets tend to perform well in that environment. Certain assets perform, it's a mixed bag, and then certain assets are typically bearish in that type of environment. So we let that fundamental gravity concept really drive what markets we're looking at bullishly, what markets we're looking at from a bearish perspective, and as importantly, what markets we're just staying away from entirely. Okay, when I say markets, I mean sectors, industries, individual companies, as well as commodities, currencies, and fixed income markets.
Sure.
So that with those two things sort of out there and understood, the euro yen, so currency trading is, I love trading currencies, and we always have a currency book in play, both long and short. The simple reason, number one is, while stocks, as a general rule, are the dumbest of the asset classes, meaning they are the last to catch on to what's going on economically, so they can diverge from those fundamental gravity seasons for long stretches of time. On the flip side of that, you've got currencies. All right, they're the smartest of the markets. They're the smartest of the asset classes because they sniff out shifts in the fundamental gravity, which are economic conditions and central bank policy primarily. They sniff those things out, and they stayed adhered to that fundamental gravity season with very few divergences, okay? Meaning if a fundamental gravity season is bullish for a particular currency, typically speaking, you're not going to get long stretches of time where that currency is trading weekly, okay? W-E-A-K-L-Y with my redneck accent. So that brings us to that. And so with currency pairs, you're always long the front currency and short the back currency, right? So what this allows us to do is to have an opinion on 40 economies in terms of fundamental gravity season. Find the economies where we're bullish, where the fundamental gravity season is bullish for the currency in question, and then go find an economy where the environment is bearish for a currency and put those two things together. Okay, so for right now, given the fundamental gravity seasons in the euro, the eurozone broadly, Australia, Japan, and the U.S., just to name four, we are bearish on the yen and the dollar, and we're bullish on the Aussie dollar, the euro, and actually the British pound as well. We're bullish on the British pound. So what we want to do is go find currency trades that take advantage of that perspective. And the one I've shared here with you here is the euro yen, which if you did this trade would put you long the euro and short the yen, okay? And what I've also provided here are what I call our alpine and abyss lines. All of our algorithms and models are built based on chaos theory and fractal geometry. And so alpine and abyss, just to make sure this is clear to the listeners and the viewers, these are not support and resistance, right? These are not lines that are drawn because you can look at a chart and see an intermediate high or low, okay? These are algorithmically calculated based on our understanding of fractals and chaos theory, and they're really areas of momentum, okay? And what that means is, so in the euro yen, the alpine line is 124.309, okay? What that means is the market, if it trades to that level, okay, and is able to close through it, it means there's a 69.8% chance that this currency will move another 3.5% minimum over the next 10 trading days, right? So the alpine and abyss lines give us, what they give us beyond, again, support and resistance, is they give us mathematical understanding of what's likely to come next. If it is rejected by the alpine line, there are statistics that tell us what is likely to happen next. Again, if you're trading in markets, all you're dealing with are probabilities. And what you want to do is stack the odds of success in your favor. Okay, any edge you can add to your toolkit is what you're looking for, and anything mathematically derived is critically important. Okay, in a similar fashion, the abyss line is 119.813, and what this simply means is this is the momentum threshold on the downside. Okay, if the euro yen were to trade through that level on a closing basis, there are statistics that would indicate that is going to, the downside momentum is going to pick up and it would go further. So that's why with this chart, we're bullish on the euro yen, but I wanted to give these alpine and abyss lines to you guys so that you could sort of, gauge where things are likely to trade with this particular currency.
Very interesting. So here favoring euro over the yen, but I'm eyeballing that alpine line at 124.30 and change, which would suggest a break of that, would suggest some further upside. We only have about 30 seconds left, Landon. I wanted to get to your second chart because we've talked a lot about gold. We've talked about crude oil recently.
Yep.
Can you apply what you talked about to the commodity complex using DBC?
Sure. Very simply, the U.S. is in a fall fundamental gravity right now. What that means is inflation is getting ready to get stoked. Okay, it's not showing up in CPI, PPI, or core. No one's talking about it. All Wall Street doing is extrapolating what's happened over the last 6 or 12 months forever into the future, as they usually do, which is why they're always late to the turns. Inflation is percolating. We like commodities. We like tips that are all-time highs right now. Gold, silver, all of those things. Again, gold is not an inflation hedge, but we do like gold. I wanted to throw that in there. But this DBC, and again, do your own homework. This is not an advertisement for this ETF. But we do like broad-based commodities. We like corn, we like wheat, we like coffee. And this ETF gives people who don't trade commodity markets directly access to that. We think inflation is a minimum of a 3 to 6 month situation here in the U.S. Okay, and possibly longer. So again, I just wanted to provide the Alpine and Abyss lines for this particular ETF. Same sort of rules apply here. These are areas of momentum, thresholds of momentum. So if GBC were to trade through the 12.80 level, it would indicate further momentum to the upside again over a short period of time, say 7 to 10 trading days. Likewise, if it breaks back down and trades below 12.00, the same would be true on the downside.
That's a great take, and certainly the stronger commodity thesis fits in pretty well with a lot of different technical approaches. I think recognizing the breakout in some of these ETFs. Landon, thank you so much for coming on the show. This was a real pleasure. I feel like I'd love to spend time digging into some of these things more. So we'll look forward to having you back on down the road. All right.
Dave, thank you so much. I really enjoyed being here, and I appreciate you having me. Talk to you soon.
It was Landon Whaley from the Whaley Capital Group in Charlottesville, Virginia. It's really interesting. I followed Landon's work for a little while. I had some great conversations with him, and I was really excited to kind of bring him on. His approach of using, sort of what he called the gravitational framework, fundamental gravity, is unique from some of the other strategists, other investors that I've talked to. So that was pretty interesting to hear how that, as always, how something like that lines up with what I'm seeing using other conventional technical tools. So a fantastic take there. We need to continue on with the show. Our next segment is called It's All Relative. And what we wanted to do was focus on relative strength and stocks that are able to get it done. As a reminder, I think when you focus so much on just the high level S&P, you're missing opportunities that lie at the sector level, at the stock level, everything in between. There's so many moving parts within the equity space. So having a good capability to screen and looking for opportunities is really, really helpful. What I did to come up with this list, what I basically thought of is we use the scooter rankings all the time, as you know, on the show. We look at stocks breaking higher and lower, and we look at the top rated stocks. So on my dashboard, I look at the top 10 stocks based on their scooter rankings. As you can see, it's really focused on a couple key sectors right now. It's it's a lot of the tech names. It's Tesla #1. There's some healthcare in here, consumer. It's a mix of some of the names that are probably very familiar. What I wanted to do though is look at each of the 11 S&P sectors and focus on the name that was #1 within that sector. I'll show you what they are, and then at the very end, I'll just very quickly show you how I came up with the list. In communication services, the #1 stock is Netflix, and probably not too much of a surprise because we've seen the resiliency of these uptrend. It's interesting on a chart like Netflix how unpainful, or that's probably not a word, but how the lack of pain in the February to March sell-off is a pretty big move, but it doesn't look as severe as you've seen with some of the other stocks. And look at how quickly mid-April it's already going to new highs and has continued higher. This is, obviously it's certainly a coronavirus quarantine sort of social distancing play with people hitting streaming services pretty significantly. But it's worth noting that Netflix is teasing a new 12-month relative high, which would be another good milestone. This is a stock that continues to make new highs. Within consumer discretionary, it's not Amazon, it's actually eBay that's the #1 stock. What's interesting on the chart of eBay, #1, look at how the relative strength has accelerated to the upside. And that's going to be something you'll notice on a lot of these charts. These are charts that have obviously been getting it done. But look at how the stock has accelerated to the upside, and look at the extreme overbought condition. What that means when the RSI is above 80 is that the upside momentum is so significant. Look back to sort of late May, early June to see what I mean. You'd expect a bit of a pullback, but overall, the momentum's so positive, you'd expect at least one more leg higher. So for me, and Tesla's in a similar bucket to eBay, they've gone vertical. It's hard to think about chasing a stock like this, but two things I would say. #1, never confuse the top of the screen with resistance. Stocks and trends can go much longer in one direction than you might imagine. And #2, focus on the extreme overbought condition, which means all else being equal, a bit of a pullback in general you can consider more buyable than sellable. Within consumer staples, Clorox is actually the #1 ranked stock. On a pure price basis, it actually looks pretty good. On a relative basis, it's come on very strong. It's actually gained 15% on the S&P on a relative basis just over the last month. And look at how the uptrend has actually been fairly consistent. Clorox is actually interesting. This is one of those staple stocks that outperformed going into the March low and then just sort of came back, but then continued on its way higher, kept pace with the market and continuing to make new highs. So in a sector that struggled a little bit, interesting to note, Clorox, one of the top. I'm going to go a little more quickly because we're a little light on time, but I just wanted to hit on some of these other ones. Within energy, the fact that the number one ranked scooter stock is only a 53rd percentile and it's Cabot Oil and Gas tells you how weak that sector is. And the energy sector has been struggling on a relative basis. This is making new swing lows, new relative lows for the last 3 months this week. But it's the number one ranked stock within the sector. Market access, when we get to financials, is the number one. S&P Global, I think, is number two, and the two of those charts feel pretty similar to me. This is a stock that actually sort of sideways moved for the last 6 weeks or so, and just resolved to the upside. So it's actually at more at a buyable level. It reminds me of the chart of gold, actually. DXCM has been the number one stock in all of our scooter rankings. It's been overtaken by Tesla. It's within healthcare, but you can see that it's actually number one here. Today, you can see how it's gone up and broken above the swing highs from May. ODFL is Old Dominion Freight Line. This is one of the trucking companies. This is within the industrial sector. A lot of people have had questions about industrials. And when you think of industrials, you think of things like Boeing. You think about airlines, all of which have been on the struggle bus in terms of their charts. But there are stocks like ODFL that are in the industrial sector that have broken out, and again, just pretty early on breaking out of a good base. We just have a couple more here, so I'm going to power through them. Newmont Mining is the number one material stock. Newmont Mining had been in the top 10 according to the scooter rankings, fell off of it, but actually emerging pretty well, especially on a relative basis. Within real estate, REITs as a whole have struggled, but you can see that Equinix EQIX is actually breaking to new swing highs and breaking above these bearish engulfing patterns. It's actually a pretty interesting chart. Now testing support around 710, 715. I think it's an interesting level to pay attention to. Just to wrap up the 11 sectors, sector 10 is technology. My cup runneth over with tech stocks that look kind of like this, but NVIDIA is the top ranked S&P stock within technology, just becoming overbought. But again, a bit of a divergence here to be paying attention to, with higher highs in price, not met by higher momentum just yet. And our last sector is utilities. American Waterworks, AWK, is the number one sector. So you can see with some of the sectors, energy, REITs, utilities, the top ranked S&P stock in the sector, not a great chart relative to some of the other ones, but if you have to find a place to hide within any of the 11 S&P sectors, my point with this segment to show you is there's an opportunity. You just have to look for the stocks that are up there the most. To come up with this list, all I did was I went to our scanning engine. I created a scan called S&P members just to look at the S&P 500. I sorted it by scooter rankings and then by sector. And I just looked at the top name in every of the 11 S&P sectors. We need to wrap this show though. And my producer Gretchen is not so briefly telling me move on. Chart number one in the 3 and 3 is the consumer discretionary sector, the XLY. This is an interesting one. It's not a cup and handle pattern ideally because this is more of a V bottom and not a rounded bottom, but I think it's interesting to note the XLY has round tripped going back to the February high, has pulled back and now retesting those highs. And I think a breakout of the XLY above 132 with appropriate follow through would be a key breakout in a sector that it hasn't been as meaningful as something like technology, which is already at price and relative highs. It's also testing a new relative high, which is important to pay attention to. Chart number 2 is the energy sector. We talked about energy stocks. And again, the fact that Cabot Oil and Gas, with not the best chart, is the number one energy stock in the S&P is a little rough. The XLE is breaking below swing lows. It's breaking to a new low. So we have the lower lows, lower highs, and the relative strength has rolled over in the last 6 or 7 weeks. So energy, I think, for the most part, you have to avoid that and wait for some sort of sign of accumulation. Finally, our third of the 3 and 3 is the S&P breadth by capped here. I mentioned this earlier in our market recap. And again, there are so many stocks like the 11 that I showed you that are holding up or emerging really strong on a relative basis, a lot of them breaking to new highs. So there are stocks out there doing it. But the question is, for the market, I think, what is the average stock doing? And I think this chart showing you the cumulative advanced decline lines, more of an equal weighted measure of strength within large cap, mid caps, and small caps. That's where you're going to see whether or not the average stock, whether or not the median stock is able to hold up. Folks, that is our show for today. I want to thank Landon Whaley from Whaley Capital joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.